everyone. I hope you're really well. I'm Pamela Hastings and welcome you to another Barometer webcast. During this webcast, we will provide a review of current market and economic conditions. We have invited two of our leading analysts, Brian McNichol and James Callahan, to join David Burrows in conversation today. As always, I encourage questions from participants via the chat, or please email me at phastings@barometercapital.ca. We will address your questions after the call. With that, I turn the conversation over to our President and Chief Investment Strategist, David Burrows. Hi, David.
Hi, Pam. Thanks very much for doing that. And thanks, everybody, for tuning in today. Last week, of course, we didn't do a meeting because it was July 1st week and July 4th, and it was a quiet week. So there's some things to catch up on today and some developments that have been taking place. As always, I'm going to try and talk a little bit about current sort of macro market environment, how that's impacting our portfolios, and what's been keeping us busy over the period. So just quickly, as has been the case really since we began doing these webcasts several years ago, we are in a structural bull market for stocks. There certainly have been corrections, but since 2013, having exited a period of just over 13 years where the market made no progress, the S&P 500 broke out to a new high and has been working its way higher ever since. Now, of course, there have been some fits and starts. Of course, the 2015-16 slowdown that was led by China. You had the quite rapid sell-off in November, December 2018. And of course, we've had this COVID situation that we've been dealing with since the end of February. But the long-term picture continues to be sort of structural bull market for stocks, much like we had through the 80s and 90s, again, with some significant interruptions along the way, but multiples were expanding and money was finding its way into US stocks because US economy had the industries that were leading the world in structural change. So just as a quick reminder, starting at the end of February, we had a very rapid decline, the fastest waterfall decline in history, most significant and faster than 1987's crash. And from the lows, we had an initial bounce, which was solid. That was probably technically driven because things got so oversold. Market pulled back a little. We had a second leg higher that was driven by some of the fiscal and monetary stimulus that got pushed into the system, liquidity. Then the market chopped sideways as we sort of figured out where things may be going. And after about 3 weeks, the market started to lift again on some falling COVID cases. And the fact that certain industries, in fact, had their business models accelerated, while others, of course, were severely crimped. So led by some groups that are going through structural change coming into this crisis and where their business models were accelerated. And then at the beginning of June, market hit a recent high and then began to consolidate. And so we have been correcting since June the 8th. And that is similar to virtually every market around the world. If you were to run through the European exchanges, while they haven't rallied as much as the US market, or the Canadian market hasn't rallied as much as the US market, all of them have been consolidating as we've been digesting the news and really some of the bumpiness of the reopening process. Now, we talked before about the fact that a major driver of asset prices is liquidity. And in red here is global liquidity, and in yellow is asset price. And so this is why they say don't fight the Fed. Global liquidity carries a big hammer, and there's lots of it out there. By some estimates, we've seen as much as $15 trillion made available to the system, and a lot of that finding its way into asset prices. In some ways, perhaps disconnecting asset prices currently with current economic factors, but with the view that this liquidity can help cushion the blow and help global economies to work their way through this problem. Now, as of the beginning of June, I think you know all of our long-term breadth indicators, which really are assessing the internal health of the market, measuring the percent of stocks performing well, were all green. So the percent of stocks in uptrends in Canada, the NYSE, and globally had been expanding. So if more and more stocks are participating in a rally, that's money being brought to bear on the market. Percent of stocks trading above their 50-day moving averages for each of those markets had been moving higher. Percent of stocks with positive weekly price momentum was moving higher. That's upward trajectory. The percent of stocks hitting new highs versus new lows, and percent of stocks trading above their 30-week or 150-day moving average. All of those were positive. Now, we're always trying to synthesize all of the news, all of the fundamental factors to try to come to conclusions as to what is happening in the market. And by following these breadth indicators, we can see the output of the market's machine. Are more and more companies performing well? That's healthy. There's no bear markets ever while these factors were taking place. And on the other hand, under the surface, are we seeing deterioration? So in the second week of June, we started to see some weakening in breadth. It doesn't mean there aren't great stocks. It doesn't mean there aren't sectors and structural themes that are doing really, really well, but there was a little bit of rot underneath the surface. By June the 24th, our NYSE breadth model had reversed down. The percent of stocks performing well started to deteriorate. Same thing for the global breadth universe. Percent of stocks above their 50-day moving averages started to decline. And if we were to look as we sit today, it's sort of continued. Percent of stocks in the NYSE went from 80% of stocks in uptrends to currently about 50% of stocks in uptrends. And the percent of stocks globally performing well in long-term uptrends, again, has started to deteriorate. So that means that sort of the generals have marched along while some of the soldiers have fallen away. And we'll try and make sense of that. Percent of stocks with positive weekly price momentum has fallen to 20%. So it was at 96%. And one by one, stocks have sort of slowed down. And clearly the generals have marched on, and that doesn't mean that we can't see that reverse and start to reaccelerate. But in the near term, we've been correcting. It makes some sense. Summer often can be a period where there's some digestion in the market. And we know there's been additional news as we've been working our way along. So the S&P 500 from the high fell 35.5% into the end of March. Markets rallied very nicely. It remains about 8% about 7.1% below the high. We've pulled back about 8% off the high June 8th, and we've been working our way backwards and forwards, market digesting the news. Now, the S&P is one thing, and it has its own makeup. The NASDAQ 100, of course, heavily technology driven, has been a different story. Not only has it recaptured the highs, but it's gone on to make new highs. And that's been driven by some very, very big dominant companies. But if you look at the Dow Industrials, it's about 12% off the highs still. It had a very significant decline. It has been recovering, but not to the same extent as the S&P, and certainly not the same extent as the NASDAQ. Wouldn't we all love to have all of our money in the NASDAQ? Russell 2000 is sitting about 16% off the high. It is recovering, but again, like other industries, going through a little bit of indigestion. So TSX, same picture, about 13% off the highs over the last 100 days. So why the differences in these indices? Well, it really comes down to makeup. We know that the top 5 stocks in the S&P right now make up 23% of the index. Microsoft, Apple, Amazon, Alphabet, and Facebook, all of them performing well. A lot like what happened in 2000 when Microsoft, GE, Cisco, Intel, and Walmart were ruling the day. Now, this can go on for a long time. I think some would think that some of them are extended. It makes sense that we've seen a little bit of weakness under the surface in some other companies because we've had sort of difficult news flow. So what have we learned? What are the things that may be impacting the market over the last couple of weeks as the market's had some indigestion? We talked on our last call that we had COVID-19 risks. We've been seeing economic risk. We had an elevation in election risk as we start to move closer to November. We had some saber rattling on trade. But on the other side, we had this tremendous liquidity in the market. The positioning remained quite defensive, meaning that there were people who were short the market that may have to cover, and that would cause buying, and sentiment was still quite cautious. So here are some things that have changed. Since the beginning of June, we've seen a significant re-ramping up in COVID cases. This is hospitalizations. So hospitalizations lag cases. And of course, deaths lag hospitalizations. So these are things that have caught investors' attention. The concept that a recovery might be just a clear, clean reopening probably is not the case. We've talked about the fact that there are have and have-nots. The difference between expectations for earnings and share prices is quite significant. Some companies are meeting and exceeding estimates because their business models have been accelerated. Some of them, you'll have to wait until we get a reopening to see their earnings come back. We talked about the fact that in our strategy, it's all about finding things that are good getting better. We don't ever try to focus on broken getting fixed. Being dependent on the world getting better in order to succeed is not a great strategy. We want to own companies that are succeeding now, where there's clear evidence. From an economic perspective, when we go around the world, these are the ISM PMI data, the growth data. There's several countries still in contraction, but things are improving or the rate of change is slowing. And we've seen some countries start to absolutely see growth in those numbers. We've all seen the employment data getting better, but from a very low number. We've seen retail sales getting better, but from a very low number. We want to see whether things continue or whether things continue to be, things level off for a while before they get better. Now, from a positioning standpoint, something has changed. In the last 4 weeks, a lot of those people who were short the S&P futures have covered. In fact, we had the greatest increase in S&P 500 minis speculation since 2007. So that short position in futures is gone. That's been covered. People have been squeezed into the market. That is no longer supportive. The number of people short spiders or S&P 500 ETF units as a hedge also has been reduced, although is still elevated. So on one side, you've had a reduction in some of those hedges. On the other side, the long positioning in single securities, portfolio manager buying individual stocks to target specific companies, is now at a multi-year high. So I don't think that we can say positioning continues to be supportive at this point, but there's still lots of money sitting in money market funds that could find its way to the market. Investors have continued to be cautious, but they are much more bullish today than they were 4 weeks ago. So at the end of the day, positioning is everything, right? We can go out and buy the S&P 500 and lug the bad stuff and also get the good stuff, or we can try and target. We've used our breadth models. We've talked a lot about leadership themes, things that are showing improving relative price strength versus the S&P 500. When this line is rising, it means whatever we're looking at is outperforming the S&P. Of course, technology has been the most major theme. Within technology, we have cloud, we have cybersecurity, we have artificial intelligence or machine learning, we have fintech, some of the technologies used by the financial services companies like payment technology. We're going to talk a little bit about that today. Internet retail has been really, really strong and clearly way beyond the old highs. We have biotech and some of the healthcare technology companies obviously benefiting in the current environment. And the likelihood that they come under pressure for pricing in this election has virtually gone to zero, given the fact that it's so important that they get brought forward. The gold sector, which we've talked about, has continued to work its way higher. Very strong last 2 weeks, trading now at new highs, and that's junior golds, large gold, silver producers, and so on. And then we talked a little bit about China and how China was ahead of the US in its improvement, and it's just recently broken out to a new high. Now, we talked specifically within China about some themes that really are accelerating. This is an ETF that represents consumer discretionary companies. Sorry, this is technology companies. and consumer discretionary companies really seeing a significant ramp. And I think that could be the beginning of something that is more significant going forward. On the other side, there have been some things you had to avoid. After an initial burst in financial services, they really have been giving it back. I think I mentioned on our last call, we had put on some small financial weights, but had come back out because they were underperforming. And they've continued to underperform. Relative price strength in this group hitting new lows. Industrial companies that might be hurt if the economy stays weak, have continued to underperform, still 19% off the highs. Oil companies. Since the beginning of this decline, oil stocks are down as a group 48.4%, some better, some worse, but that really only continues a theme where the oil sector is down 85% since 2014. So clearly, there are some areas that we have to avoid. Groups that were overowned, but that are not benefiting in this environment. Some of the high dividend paying stocks. So the utility sector sitting still 18% off the highs, and the REIT index down 28%. So this is where these breadth models really help. They helped us to target where we're seeing expansion, and they've helped us to avoid some of these difficulties. Stop losses have taken us out of a lot of positions, but this high dividend theme is one that is not working. And so what we've been focused on in our income strategy is dividend growth, which still is not as exciting as the growth stocks in the NASDAQ that are really rocking, but they certainly are performing better. If you take the firm's positions as a whole, now of course this has relation to equity strategies, income strategies, and balanced. So the weightings are all different depending on the mandate. Technology is overwhelmingly our largest position at close to 35% of our overall equity exposure. Materials, which specifically is gold, is 12%. That's a great hedge against what's going on in the economy. Healthcare is a little over 11%. Communication services are at 10%. A lot of that has to do with companies like Google, the internet companies. Consumer discretionary, like Amazon at 8%. Financials, and largely financial technology at 7.5%. These are where our exposures are, and then very small exposures in industrials, real estate, consumer staples, utilities, and energy. So what is the upshot? The upshot is that the portfolios are doing very well. Some better than others. The income strategies down 7%, but certainly versus where the REITs are at down 28, or the utilities are at down 18, it's doing very well versus its universe. If we were to look at how it's doing versus the high dividend ETF of the S&P 500, it's down 26% still year to date. So realistically, income portfolio doing quite well relative to its peers. Balanced portfolio is down 1%. Remember, the market is down about 7.5% overall. The equity portfolio as of today is up 21%. And the long short portfolio, which has even more sort of growth stocks in it, is up 26%. So all these portfolios performing really well. Our macro portfolio is positioned much more defensively. It's a long short portfolio and is set up to take advantage of what we think could be some sloppiness through the summer, and we'll work our way forward there. The net of it is, I think we're in a structural bull market, and this is going to go on for a while. We think that there can be choppiness, but we have some really clear leading themes. What I thought I'd do is ask James Callahan, who's one of our portfolio managers and analysts, to come on and talk a little bit about a couple of the technology companies that we're focused on in fintech, just to give you a sense for why it is that their business models are accelerating. James? James, are you there? Well, okay. Brian, are you there?
Yep, I'm here.
Brian, do you want to talk a little bit about some of the Canadian names?
Yeah, for sure. So two key themes I really want to touch on are the rise in e-commerce and the major disruption in global supply chains we're seeing due to COVID, as well as discuss some individual names that we are invested in order to play on these themes. So in e-commerce, it's very easy to talk about the Shopifys of the world and their massive success story, becoming the largest market cap company within Canada after just being 5 years public. But what I instead want to talk about is another company that's benefiting, and that's Cargojet. So Cargojet operates air cargo transportation services within Canada and along with some international routes. Domestically, they are one of the only monopolies within Canada, given their market share of over 90%. And with restrictions on foreign companies flying domestically within Canada, market share is truly not in any danger. So during COVID, Cargojet has really been benefiting from the pickup in e-commerce as business to consumer volumes are trending at levels that were typically seen around the Black Friday, some Cyber Monday period. And we should see them be a big beneficiary of the economy coming back, as their business to business volumes will provide a natural tailwind to their overall business. Cargojet is seeing strong demand from international shippers as passenger planes have been grounded, and they usually transport just under 50% of all international shipments in the belly of the plane. And Amazon is a key partner with Cargojet, owning about 10% of the company and giving Cargojet an established partner that aims to grow alongside them within Canada. The other theme is definitely the disruption we're seeing on global supply chains. So it's no question that COVID's caused a major disruption on the global supply chain network as production has slowed and shipments were delayed. In a post-COVID world, companies will be looking for better solutions to help navigate these type of events by improving their supply chain management systems. So simply put, supply chain management is the management of flow of goods and services. It involves monitoring the movement and storage of raw materials, inventory, and of finished goods, as well as end-to-end order fulfillment from a point of origin to a point of consumption. Managing supply chains has really never been harder. Increasing cost pressures, growing customer expectations, disruptions such as the period that we're currently in, and expanding ecosystem all add to the already complex equation. So in Canada, we're looking to capture on this theme of the ever-increasing complexity through both Kinaxis and Descartes System Group. So starting with Kinaxis, they offer a more focused product on supply chain management, allowing customers to conduct rapid concurrent planning using collaborative decision-making and what-if analysis in order to assess supply and demand for their end products. Their product is considered to be far and ahead of their closest competitor, SAP, and they continue to bring on large global corporations. Descartes, on the other hand, offers a more of a strategic blend of supply chain management as well as logistics management. So they focus on helping navigate every aspect of the supply chain, from working through different government regulations, custom brokers, carriers, and shippers. So each subsegment they provide offers a different subscription, which allows them for strong cross-selling opportunities within their customers. So both companies have very long sales cycles, roughly 9 to 18 months. So we really should see a nice boost to their financials for the next 2 years or so as we enter a post-COVID world and large corporations look to improve on their own internal solutions.
That's great. Now, Brian, what is your sense as to the stickiness of this business? If we start to see things improve, what do you think is the likelihood these customers are going to go back to the old ways of doing things?
It's extremely sticky. So the reason why their sales cycles are so long is a lot of it is onboarding as well. So they put most of the information that are within these companies onto their own service. Really, the only way we would see them switch to either their historical method or to a new customer is just around pricing. And both companies have a very strong track record of maintaining customers.
Great.
I think Kinaxis in their history has lost one customer, and that was just due to pricing. But that's the only customer known to be lost.
So my sense of it is that these structural themes, as they continue to come along, they are really only picking up steam, and the customers, the number of customers, the breadth of the business continues to improve, and so we can continue to see multiples really support these share prices. I wondered if James is there.
I am now. Sorry, all. I went to unmute myself and accidentally hung up the call. So
okay. So Brian, you're going to talk a little bit about, James, some of the fintech companies we're in.
Yeah, absolutely. So I'll set it up like this. I know, Dave, you've talked on these calls before, and it does to some degree underpin our investment process that capital tends to flow where it's treated the best. And over the last number of years, a lot of capital has flowed into the payments industry because of how great the business models are and how durable the growth is. So there's obviously nuance from company to company, but broadly, companies in the payments industry have invested to build a pipeline, and then they just charge a toll to use it. It is a pretty simple business model. Typically in the past, Visa and MasterCard have been staples in Barometer portfolios, and while we have small positions there now, about 50% of earnings for both companies come from cross-border transactions, and as COVID has impacted travel, there's been some weakness there. So we've really tried to focus on consumer or person-to-person payments and e-commerce, because both of those verticals have remained strong, and we've done so through owning Square and PayPal. So let's start with Square. It's a super exciting company. They're in the very exclusive club of companies that grow revenue more than 40% per year. Two components to the business. There is the legacy seller ecosystem and then the Cash App ecosystem. So the seller ecosystem is really a one-stop shop for small and medium-sized businesses. They've expanded now beyond the original point-of-sale hardware offering, which was that little credit card scanner that would plug into iPhones, and now really have a full suite of hardware offerings to accept payments and software offerings like invoicing, payment, payroll, real-time dashboards for small businesses and that sort of thing. Pretty interestingly, they also offer loans to businesses that are repaid with a percentage of revenue, which is such a smart thing. Loss rates are low because they see all the merchants' revenue, and that's how Square calculates the terms they're willing to offer. And then they sell the loans to fixed income investors. So some of the named investors are Morgan Stanley Investment Management and Canada Pension Plan. Besides that, they have an online store product that's seen a huge uptick in demand since the COVID lockdowns. That's helped merchants set up e-commerce capability pretty quickly. So before, merchants would have to juggle different vendors and manage everything a small business needed to do. So the consolidation of all of this and the integration into one product makes for a compelling value proposition. To process a payment over their point of sale system, the sellers charged a 2.5% of the transaction amount plus 10 cents. And then the add-ons cost extra on top. In 2019, they processed about $100 billion in payments and made $1.5 billion in profit from the seller ecosystem. And more exciting than that is Cash App. So the other part of Square's business, it's about 25% of their business right now, is called Cash App. It started off as a way for a person to send and receive money electronically, but it's really grown beyond that. Now it really is a money management platform. So what can you do? You can still send and receive electronic payments. It's much like e-transfer in Canada, but it's exclusive to the US. You can deposit checks. They offer a debit card, so you can use your Cash App balance to transact with businesses, and you can buy stocks and cryptocurrency. So it's digital banking for the underbanked, and it really gives you most of the functionality you'd see from a mobile banking app. Cash App's been growing explosively. They grew active users 15 million from 15 million in 2018 to 24 million in 2019. So that's 60% year-over-year growth. And we expect they had a very solid quarter of growth in the second quarter of 2020 as stimulus check recipients were able to have their stimulus money direct deposited into their Cash App accounts. So we don't know exactly what kind of growth they've seen, but Jack Dorsey, who's the CEO, has said that it was a transformative quarter. So we're going to be watching that closely. So obviously growing Cash App at a rapid clip, faster than the banks are growing their mobile apps, and they continue to broaden product offerings and increase the lifetime value of a customer. For a lot of Americans, there really is no reason to have a bank account because you can do almost everything you need to do on Cash App. So significant runway for growth. About 30% of US households are identified as being underbanked. So we've obviously seen some above average growth from new users depositing stimulus checks, but they should continue to grow strong. So two fantastic businesses within Square growing strong, and that's all before international expansion, which is a pretty attractive growth lever. And then our other investment in this space has been PayPal. So obviously much bigger than Square. They do about 18 billion in revenue per year to Square's 5 billion. It's slower growing. They grow revenue at 15% per year, but have many of the same product offerings and exposures. So like Square, they have product offerings for merchant card acceptance and some small business solutions, and the original peer-to-peer money transfer app Venmo, but are more levered to e-commerce adoption than Square, given their history with eBay and their online payment solution business, which, given rapidly accelerating e-commerce adoption driven by social distancing, that we think is a trend that persists. It's a good exposure to have. So PayPal's global. The US makes up only about 50% of revenue versus Square's domestic US focus. So there's some diversity there. And the average rate that they charge for a transaction is about 2.25 to Square's 2.5, and then a 10% or a 10 cent on top of that. So specifically to touch on the peer-to-peer side, Venmo offers many of the same services that Cash App does, except for no investing functionality. But given the ability for stimulus checks recipients to have their stimulus money direct deposited into a Venmo account, we think Venmo's setting up for a similarly strong quarter, and this huge user growth, along with immensely accurate e-commerce adoption, should be transformative for PayPal as well.
James, we're seeing a reopening take place. We have seen a pickup in retail sales in the U.S. the question, I think one of the questions people have is that if retail is not able to reopen as quickly, does it have much impact really at all on Square or PayPal, or are they really predominantly, e-commerce driven?
So PayPal is predominantly e-commerce driven. It does have a bit of an effect on Square because they are pretty levered to small and medium-sized brick and mortar retail. They've done a really good job over the last few years of diversifying away from that and getting more into offering their merchants e-commerce offerings. And then Cash App provides a buffer there as well. So more so for Square than PayPal.
Great. Well, thanks very much. Thanks very much, guys. I guess the last thing I wanted to touch on is that we, of course, have been going through this merger with Roundtable Partners. We're very, very happy to have our new partners on board, and we've been busy integrating systems, and it's all going very well. One of the things we'd like to start talking a little bit about is some of the alternative investment strategies that they have used over time. We do think that the future for public markets, continues to be really, really good, but we do want to continue to find ideas that can be diversifying and can just offer different types of investment returns. I think most of you know that we, a year ago, launched our first fund investing in music royalties. It has been a smashing success. We will be doing another. Roundtable has done several partnerships investing in commercial real estate and raising credit for real estate development. And so we're going to make one of the next two calls topics, alternative investments. And the idea is to find income streams that would be diversified away from public markets. So to that extent, I'll look forward to talking about it. Certainly, our investment counselors are well versed, and if you're interested in having a conversation before then, certainly they'd be interested in doing that, and that's something to be bringing forward. We're going to continue to track all of the internal data that we track from a market perspective. At this point, while there is some sloppiness in our data, and we do have some caution in the portfolios, our themes continue to work really, really well. If things deteriorate further, or if the COVID news starts to matter, then we certainly can get a lot more defensive. As we sit, all the portfolios are different. Equity portfolio is very growth focused. The income strategy, obviously very income oriented. Balanced strategy aimed at being very low volatility, and it is doing that. And it is, as it is right now, the portfolio that we have set up to take advantage of any weakness that we may see through the summer is the macro portfolio that is quite hedged from an equity perspective, but very exposed to precious metals in China. And again, is a diversifier. If things get difficult, we'll get a lot more defensive. We'll continue to update if there are changes that take place intra-week. We will update electronically. Don't hesitate to give us a call if you've got any questions, and we look forward to speaking to you again at the same time next week. Pam and James and Brian, thank you very much for being on the call. Pam, if there's any questions, certainly we can take them.
Dave, one question, just if you could comment on gold and the gold market right now.
Yeah, sure. Look, we've been talking about this sort of through the course of the year, and I'm just going to pull the lens back. There is a picture of gold going back to 2004. Gold rallied sharply into 2011 and then went through a bear market and has gone through a consolidation period, and the price of gold has started to ramp again. We're getting very close to being back at all-time highs. Gold tends to do well in different types of conditions, tends to be a hedge against economic risk, which I suppose is a concern right now. Probably more importantly, it is used by investors as a store of value. I said at the beginning of the call, there's been roughly $15 trillion globally pushed into the system. Some of that is a lot of it's monetary policy and effectively money printing, which does devalue currency, paper currency. And so we are seeing a significant move into gold itself, and then gold producers, more importantly, actually add leverage on top of that. The reason that gold producers tend to do better when gold is rising than gold itself is that not only do they get credited with the earnings that they get producing gold, but the value of what they have in the ground goes up. So they may have 15 or 20 years worth of gold in the ground, and it all goes up in value. So this is one of the reasons that we're seeing some of these companies perform so well. And we've got sort of a range of holdings. This is B2 Gold. We have Great Bear Resources. We have Franco-Nevada, which has been performing really well. We have Newmont. We have Barrick Gold. All of these companies, exposed to this theme. And then we have some silver producers. And silver is, again, a little bit more intensely levered to the precious metal prices. Silver prices can move dramatically relative to gold itself. So this is certainly a theme, and as I mentioned, it's I think about 12% of our assets, depending on the portfolio. Some it's more, some it's less. I think macro is 23-24% precious metals, and it's a theme that is not dependent on the economy getting better. So I think that this is one that has some legs to it. By my measurements, gold could be $2,500, $3,000 an ounce over the next couple of years. Any other questions, Pam?
Thanks, Dave. 1 second. We have a couple more questions here. Okay, here's one. Do you see Apple buying Sonos? This has been talked about recently.
Well, look, would it make sense? Sure. Apple is such a dominant company. It's got such a user base that, they went out and they bought the headphone company. They've done really, really well with different peripherals. Sonos is a pretty dominant company on its own in its space, but if it had Apple's customer base, would certainly be of value. I think you can own Sonos on its own. I think you can own Apple on its own. Together, they probably would add a lot together.
Wonderful. Dave, I think that concludes our questions for today. Thank you very, very much. If we didn't get a chance to address your questions, we will offline. And of course, if you have any ideas or topics you'd like us to address or cover over the course of our webinars, we're happy to do so. We're always looking for great ideas and content, as I believe we're going to be taking these webinars through the summer. So please don't hesitate to email me, phastings@barometercapital.ca. Thanks so much, Dave.
Thanks, everyone, for tuning in.